The United States is the largest economy in the world. It commands the most powerful military force on the planet and represents nearly half of the entire global stock market. On the surface, this makes America appear untouchable. Strong currency, dominant companies, unmatched defense, and deep financial markets have protected it for decades. But behind this massive shield lies a growing vulnerability, one that is only now starting to be tested. A weakness not in weapons, but in money. And increasingly, that weakness is being exposed by America's own political choices. Since returning to office, Donald Trump has used America's economic strength aggressively. Tariffs have been imposed not just on traditional rivals, but also on long-standing allies. Europe, Japan, and even Canada have felt the pressure. Trade restrictions, political threats, and military rhetoric have replaced cooperation. Until recently, there was little these countries could do in response. That may now be changing. China recently sold a record $5.1 billion worth of US assets in a single move. Across the world, government bonds are no longer viewed as the perfect safe haven they once were. Large investors are moving money between stocks, bonds, corporations, governments, and derivatives faster than ever. Many analysts believe the next major financial crack may appear in the bond market itself. America currently carries about $38 trillion in national debt. That debt, once a symbol of trust, is now becoming a potential weapon against it. Since 2021, China, once the largest foreign holder of US Treasuries, has sold more than $340 billion worth of American debt. And China is not alone. Several American allies are quietly reducing exposure as well. Some European hedge funds have even dumped US equities entirely as a form of retaliation. At the same time, European governments are scrambling to increase defense budgets. But what if the most powerful weapon they have isn't missiles or tanks, but financial pressure? This raises a serious question. Has financial warfare begun? To understand this, we need to understand debt. For nearly a century, the United States has acted as the world's banker. Whenever it needed money, it simply issued bonds. Countries around the world rushed to buy them. Japan, China, and the United Kingdom each hold hundreds of billions of dollars in US debt. They do this because US Treasuries have long been seen as the safest investment in existence. The US government pays interest on these bonds, usually around 2%. That may seem small compared to stock returns, but the difference is stability. Companies can fail, governments rarely do. Investors trust America because of decades of political stability, deep markets, and economic growth. That reputation took generations to build, but it can unravel quickly. Today, the US owes about $110,000 per citizen. For most countries, that would be unmanageable, but America survived because investors accepted very low interest rates in exchange for safety. That trust allowed America to borrow endlessly without breaking the system. However, debt carries risk. At current levels, the US already spends close to $1 trillion per year just on interest payments. That is more than its military budget. Even a small rise in interest rates can add tens of billions of dollars in extra costs. The Treasury market works like any market, supply and demand. The US issues more debt every year. Buyers include American institutions, the Federal Reserve, and foreign governments. But when foreign buyers reduce demand, or worse, start selling, the balance breaks. The government must offer higher yields to attract new buyers. Higher yields mean higher costs for every dollar borrowed. If major countries sell aggressively, supply rises, demand weakens, and interest rates climb rapidly. This is where Trump's foreign policy connects. Since returning, Trump has created repeated international crises, tariffs on allies, threats to trading partners, arrests of foreign leaders, and now controversial ideas about Greenland and NATO commitments. Europe and Asia find themselves facing an America they cannot easily confront. Military confrontation is unrealistic. Diplomatic protests change little, so attention shifts to money. With $38 trillion in his debt, around 25% is held by foreign investors. Most of it sits in the hands of European nations, East Asia, and Canada, exactly the countries now under pressure from US policy. That creates a dangerous imbalance. US Treasury yields have risen sharply in recent months. Even small increases translate into tens of billions in new annual interest costs. Already, some cautious signals have appeared. A major Danish pension fund announced plans to sell all its US Treasury holdings. On its own, that means little, but it signals changing behavior. China has already been reducing exposure for years. Now, Western allies are discussing alternatives. France and Germany want the euro to become a stronger reserve currency. Japan has warned that US trade trade policy risks destabilizing global markets. If even one major holder like Japan or Canada began selling in large volume, it would shock the system. Bond prices would fall, yields would rise, and US interest costs could explode by hundreds of billions of dollars annually. That strain would not stop at government finances. Interest rates influence everything: mortgages, credit cards, business loans, student debt. When Treasury yields rise, investors move money into bonds and away from risk assets. That drains liquidity from the rest of the economy. Loans become more expensive, spending slows, businesses cut back. Last year, US consumer debt reached $18 trillion, more than double what it was in 2003. If interest rates rise sharply, households would see more income swallowed by repayments. That creates a cost of living squeeze and increases recession risk. In other words, financial pressure can hurt America without firing a single shot. Yet weaponizing debt is dangerous for everyone. Most US debt held abroad is owned by private institutions, not governments directly. To force mass selling, governments would need to pressure their own financial systems in ways rarely seen in democratic economies. And if many countries sold at once, prices would collapse. They would take massive losses themselves. Trillions of dollars could evaporate globally. Pension funds, banks, and currencies would suffer. A US debt crisis would not stay inside America. It would ripple through every market on Earth. That is why financial warfare is powerful but unstable. America's strength has always depended on global confidence. Its economy dominates because others believe in it. Once that belief weakens, the system becomes fragile. Trump's policies risk turning allies into financial adversaries. Greenland, NATO, tariffs, and sanctions are not just political issues anymore. They touch the foundation of global capital flows. The paradox is simple. The United States is powerful because the world trusts it, but the more aggressively that power is used, the more that trust erodes. And when trust disappears, even the strongest economy becomes vulnerable. Not to bombs, but to numbers on a screen. Banks, pension funds, and sovereign wealth funds depend heavily on US Treasuries because they are treated as the safest collateral in the global financial system. They function like a universal guarantee, and asset lenders' trust will still hold value tomorrow, regardless of what happens today. Treasuries sit at the foundation of global lending, derivatives, and liquidity markets. But that safety comes with a condition. If the value of treasuries begins to fall, banks are suddenly required to post more collateral to secure the same loans. When institutions cannot meet those demands, their funding is reduced or pulled entirely. That puts pressure on balance sheets and can push banks toward insolvency. This is the same mechanism that amplified the 2008 financial crisis. What began as stress in US markets rapidly spread across the world because the entire system relied on the same collateral. A similar dynamic would unfold if countries ever coordinated a large sell-off of US government bonds to pressure Washington. Falling prices would weaken collateral everywhere, triggering margin calls, forced selling, and funding shortages. Because every major financial institution depends on treasuries, such an action would not just harm the United States, it would destabilize the global system itself. That shared dependence makes financial warfare unlikely in practice, but the fact that the option exists still matters. No matter how powerful a US president may be, global capital still provides a lever. We saw a hint of this when Donald Trump softened his stance on Greenland at the World Economic Forum, where political leaders meet with the heads of major banks, asset managers, and sovereign wealth funds. There, investor Ray Dalio warned that aggressive geopolitical behavior could trigger capital wars and financial retaliation. Soon after, Trump publicly stated that he would not use military force to take the island, walking back his earlier position. The episode highlights a deeper truth. The United States sits at the center of global finance not because it can force others to lend, but because it has historically been stable, predictable, and reliable. That reputation allows the US government to borrow trillions at relatively low interest rates, run persistent deficits, and finance the largest military budget in history. Yet this position depends entirely on confidence, and confidence is far easier to lose than to rebuild. The paradox is clear. The same financial system that gives America enormous power also creates vulnerability. Trust sustains it. Once that trust weakens, even the strongest economy becomes fragile. At the same time, global uncertainty is driving investors toward hard assets. Major banks have turned aggressively bullish on gold. HSBC, JP Morgan, Goldman Sachs, and Bank of America all project gold prices approaching or exceeding $5,000 an ounce in 2026. Silver and copper are also trading near record levels, while mining stocks are finally responding. In unstable times, money searches for safety, and increasingly, that safety is no longer found only in government debt, but in tangible assets that exist outside political systems.